The world of investing can be exciting, but it's also full of potential pitfalls. Today, we're here to help you avoid some of the most common traps that can trip up even the most enthusiastic beginner investors. So, grab your metaphorical helmet, because knowledge is your best defense. And let's dive into the investing minefield and learn how to navigate it safely. Trap number 1. The get-rich-quick mirage. The siren song of instant riches can be deafening, especially for new investors. We've all seen them: flashy ads, social media influencers promising life-changing opportunities, and breathless news stories about the latest cryptocurrency soaring 1,000%. But here's the reality: sustainable wealth building is a slow and steady climb, not a rocket ride to the moon. These get-rich-quick schemes are often elaborate mirages, designed to separate you from your hard-earned cash. They prey on your fear of missing out, FOMO, and dangle the promise of effortless fortune. Here's how to spot these red flags and avoid getting burned. Unsolicited investment offers. Legitimate investment opportunities won't come knocking on your door or pop up in your social media feed. Be wary of anyone pressuring you to invest quickly, especially without understanding your financial goals and risk tolerance. Guaranteed returns with high risk. Remember, the higher the potential reward, the higher the risk. If someone promises high returns with little to no risk, it's a major red flag. Real investment involves calculated risks, and responsible advisors will always emphasize the potential for losses. Complex investment products you don't understand. If you can't explain an investment in simple terms, it's probably not a good fit for you. Don't be pressured into complex financial products you don't fully grasp. Stick to investments you understand and can research thoroughly. Focus on the underlying asset. If many get-rich-quick schemes involve complex financial products with little to no underlying value, ask yourself, what is this investment actually tied to? Is there a real product or service backing it up, or is it just hype? Trap number 2. The herding mentality. Following the crowd. The fear of missing out, FOMO, is a powerful emotion, and it can be especially dangerous in the investing world. Here's why following the crowd can be a recipe for disaster, and how to develop your own independent investing strategy. The Pied Piper of price hikes. Imagine everyone rushing to buy a new stock because it's a hot. This sudden surge in demand can drive the price up, often beyond the stock's true value. By the time you jump on the bandwagon, you might be buying at an inflated price, setting yourself up for potential losses if the market corrects. Ignoring the underlying fundamentals. Just because a stock is popular doesn't mean it's a good investment. Smart investors look beyond the hype and focus on the company's fundamentals, such as its financial health, future growth potential, and competitive advantage. Don't get swept up in the crowd. Dig deeper and understand the company before you invest. Emotional investing versus calculated decisions. Following the crowd can lead to emotional decision-making. You might feel pressured to buy a stock simply because everyone else is doing it, even if it doesn't align with your investment goals or risk tolerance. Remember, investing should be a strategic process, not a popularity contest. Here's how to invest like a lone wolf, but not a reckless one. Do your own research. Don't rely on social media hype or tips from your unqualified neighbor. Research the companies you're considering, read analyst reports, and understand the industry trends. Develop your investment strategy. What are your financial goals? What's your risk tolerance? Develop a long-term investment plan that aligns with your needs and risk profile. Don't just blindly follow the crowd. Chart your own course. Don't be afraid to be different. Sometimes the best investment opportunities are the ones that are under the radar. While it's wise to learn from others, don't be afraid to think independently and invest in companies you believe in, even if they aren't the hottest stocks on the market. Trap number 3. Emotional roller coaster investing. Here's the problem. Letting your emotions dictate your investment decisions is a recipe for disaster. Instead of reacting impulsively, we need to become masters of our financial emotions. Fear, the silent saboteur. Market downturns are scary. The news is filled with doom and gloom, and it's easy to panic and sell your investments at a loss. But remember, short-term fluctuations are normal. If you have a long-term investment plan focused on quality companies and diversified assets, a temporary dip shouldn't derail your entire strategy. Greed, the whisperer of impatience. On the flip side, when the market soars, it's tempting to chase the hottest trends and expect those sky-high returns to last forever. But remember, what goes up must eventually come down. Stick to your investment plan, don't get caught up in the hype, and avoid chasing unrealistic returns. Taming the gremlins. So, how do we keep our emotions in check? Here are some strategies. Develop a long-term plan. Having a clear investment strategy with defined goals and risk tolerance helps you stay focused during market volatility. Stick to your plan, even when emotions cloud your judgment. Focus on the fundamentals. Don't get swayed by market noise. Focus on the underlying fundamentals of the companies you invest in, their long-term growth potential, and their industry trends. Invest regularly and emotionally detached. set up automatic deposits to your investment accounts. This removes the emotional element of buying and selling based on market fluctuations and ensures you stay consistent with your strategy. Or take breaks from market watching. Constant exposure to market news and stock quotes can heighten anxiety. Schedule dedicated times to check your investments and avoid refreshing your portfolio app every 5 minutes. Trap number 4. Chasing past performance. We see a stock or investment that skyrocketed in recent years, and our brains naturally go, hey, that's a winner. Let's jump on that bandwagon. But hold on there, partner. While past performance can be a tempting indicator, it's not a crystal ball that guarantees future success. Here's why chasing past performance can be a dangerous trap for beginning investors. A past performance is not equal to future results. Just because a company or investment did well in the past, doesn't mean it's destined for future glory. Market conditions change, industries evolve, and companies can fall out of favor. Focus on the company's current fundamentals, its future potential, and how it aligns with your overall investment strategy. Beware of survivorship bias. We often only hear about the success stories, the companies that soared in value. But what about the countless others that fizzled out? Survivorship bias can skew our perception of how common high returns are. Remember, there's no guarantee you'll be picking the next big winner. Focus on intrinsic value, not just past price. Don't get caught up in the hype of a stock's past performance. Instead, dig deeper and understand the company's underlying value. Analyze its financials, its competitive advantage, and its long-term growth prospects. Are they a leader in their industry? Do they have a sustainable business model? These are the factors that will truly determine the company's future success. Don't be blinded by short-term gains. Sometimes, past performance can be fueled by temporary factors or market bubbles. Don't chase a hot stock simply because its price is inflated. Look for companies with solid fundamentals and a track record of consistent growth, even if their past returns haven't been eye-catching. Trap number 5. Ignoring diversification. Imagine this. You're walking a tightrope over Niagara Falls. Sounds terrifying, right? Now imagine doing it while balancing all your worldly possessions on a single, rickety wicker basket. That's essentially what you're doing when you ignore diversification in your investment portfolio. Diversification is the cornerstone of smart investing. It's the golden rule, the mantra you repeat before every investment decision. Why? Because it's your safety net on that metaphorical tightrope. Here's why diversification is crucial. Spread the risk. Markets are unpredictable. What's hot today can turn cold tomorrow. By diversifying across different asset classes, you're not hinging your entire financial future on the performance of a single stock, industry, or even country. If one area of your portfolio takes a hit, the others can help balance it out. Reduce volatility. Diversification helps smooth out the inevitable ups and downs of the market. While some investments might experience a dip, others might be performing well, reducing the overall volatility of your portfolio. This can give you peace of mind and prevent you from making emotional investment decisions based on short-term fluctuations. Exposure to different opportunities. The investment world is vast and ever-changing. By diversifying, you gain exposure to a wider range of potential growth opportunities. You might invest in established companies for stability, growth stocks with high potential, or even real estate or commodities to hedge against inflation. Or tailor it to your risk tolerance. The beauty of diversification is that it's customizable. Young investors with a longer time horizon can take on more risk by investing in a higher percentage of stocks. As you approach retirement, you might shift your portfolio towards more conservative assets like bonds to protect your principal. What are your biggest fears or questions about investing? Share them in the comments below. Also, if you enjoyed this video, be sure to like and subscribe.